Stop looking for the next hypergrowth tech stock. I am going to say something that the financial industry has spent 30 years trying to keep you from hearing, because the moment you understand it, you stop needing overpriced advisors, complicated 12-asset portfolios, and the daily anxiety of watching your brokerage account like a hawk. You do not need 50 ETFs. You do not need to chase earnings calls. You do not need to time market peaks or predict Federal Reserve announcements. You do not need to pay someone 1% of your entire net worth every single year just to tell you things are going fine. You need 3 ETFs, 3. That is the complete answer, right now. As macro parameters rotate in 2026, broad retail investors are stuck in overvalued positions misallocated across dozens of funds with overlapping exposures and redundant fees. Meanwhile, institutional capital, sovereign wealth funds, pension structures, endowment portfolios managing billions, is quietly executing the exact 3-pillar system I am about to show you. They do not do this because it is simple. They do it because the data proves it works across every market cycle, every inflation regime, every drawdown, and every recovery. In this briefing I am delivering the exact 3-pillar institutional blueprint. 3 core US-listed exchange-traded funds you can buy today, automate completely, and hold forever. We are breaking down real cash flow backtesting metrics, expense ratio math, allocation percentages, and the exact structural logic behind every decision. If you want uncompromised, institutional-grade financial analysis completely free, this channel exists exactly for that. Hit subscribe right now. Let us unlock the numbers. Before you build defense, you must own the entire American economy. Not 500 companies, not the top 100, all of it. Pillar 1 is the Vanguard Total Stock Market ETF ticker, VTI. VTI was launched in 2001 and it is now one of the largest single investment vehicles on Earth. Current net assets, $2.2 trillion. Let that number register, $2.2 trillion. That is not a niche product. That is the institutional baseline of long-term American equity ownership. VTI tracks the CRSP US Total Market Index, which represents approximately 100% of the investable US stock market. The fund holds over 3,500 individual securities spanning large-cap technology giants, mid-cap industrial leaders, and small-cap growth engines that most investors have never heard of but that have historically delivered some of the strongest long-run returns in the equity universe. Now here is the data point that matters for 2026 specifically. There is an 88% overlap between VTI and the standard S&P 500 tracker. The remaining 12% that VTI adds is where the structural advantage lives, mid-cap and small-cap exposure, and that 12% is suddenly extremely important. In 2026, FactSet is forecasting year-over-year earnings growth of 29% for the S&P 600 small-cap index. That is stronger earnings growth than even the vaunted NASDAQ 100. And the S&P 600 is currently trading at a forward price-to-earnings ratio of 16. Roughly a 25% discount to the NASDAQ 100 valuation. Better earnings growth at a cheaper price. That is the definition of structural upside that standard S&P 500 holders are completely missing. Small caps are showing signs of life. Earnings growth is accelerating, and they are outperforming large caps. VTI captures all of that automatically, without you having to add a second fund or manage additional positions. The structural efficiency of VTI is near perfect. Expense ratio, 0.03%. That means you pay exactly $3 per year for every $100,000 invested. Over a 20-year horizon, this eliminates fee drag entirely and allows compounding mechanics to run at absolute maximum velocity. Real performance data as of May 2026, VTI 1-year total return with dividends reinvested, 28.82%. 5-year total return, 81.22%. 10-year total return, 312.13%. Since inception in 2001, total nominal return of 885.79%, compounding at 9.6% per year. Current net assets stand at $2.2 trillion. Year-to-date return through May 21, 2026, 9%. 1-year return, 28.5%. Current dividend yield, approximately 1.09%. This is not an income vehicle. VTI is your growth accumulation core. You do not trade it. You do not time it. You accumulate it systematically, activate dividend reinvestment, and let the full power of American capitalism compound in your account indefinitely. VTI is your foundation. Everything else gets built on top of it. A growth core without a liquid income compounding engine is an incomplete portfolio. You are building wealth on one rail instead of two. Pillar to fixes that permanently. Our second pillar is the Schwab US Dividend Equity ETF ticker, SCHD. SCHD manages approximately $91 billion in assets and charges an expense ratio of just 0.06%. The current distribution yield is approximately 3.3%. But that surface number understates SCHD's real structural power by an enormous margin. SCHD tracks the Dow Jones US Dividend 100 Index. To earn inclusion in this index, a company must have paid dividends consistently for at least 10 consecutive years, then survive a four-factor quality filter: cash flow to total debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. This is not a simple high-yield trap collecting weak companies that pay large dividends before going bankrupt. This is an institutional quality screen that eliminates fragile dividend payers automatically and retains only the most financially durable income generators in the U.S. market. The fund's top sectors are consumer non-durables, electronic technology, and health technology, with top holdings that currently include Qualcomm, Texas Instruments, United Health Group, Coca-Cola, Chevron, Merck, and Verizon. The dividend growth rate is where SCHD's real weapon activates. SCHD's dividend has grown at roughly 10 to 12% annually over the past decade. This is not a fixed income instrument where the payment stays the same forever while inflation slowly destroys its real value. This is a rising income stream that has historically outpaced inflation every single year. Now let us run the actual compounding mathematics. Start with $100,000 in SCHD today. Year 1 at 3.3% yield. You collect $3,300 in quarterly dividend payments, classified predominantly as qualified dividends, taxed at 0, 15, or 20% long-term capital gains rates depending on your income bracket, far lower than ordinary income tax rates. Activate dividend reinvestment, DRIP. Now those $3,300 automatically purchase more SCHD shares. Year 2 with 10% dividend growth. Your yield on original cost has expanded to 3.63%. Year 3, 3.99%. Year 5, 4.83% on original cost. Year 10, $8,560 per year in passive income from the same original $100,000 investment you made once and never added to again. Early investors who purchased SCHD at its inception in October 2011 are now collecting a yield on cost of approximately 12.5% on their original capital. 12.5% in annual passive income, without selling a single share. That is the drip compounding machine working across a 15-year horizon. Over the past 10 years, SCHD returned 13.01% annualized versus 15.67% for VOO. But in the year-to-date period through 2026, SCHD has delivered 18.57%, significantly outperforming VOO's 9.23% return. The 2026 environment specifically favors SCHD. In this environment, value stocks outperforming, elevated volatility, and rates staying higher for longer, SCHD benefits from the value rotation directly, as its quality dividend screen tilts heavily toward value sectors. Hold SCHD in a taxable brokerage account to capture the qualified dividend rate. This is the tax optimization move that turns a 3.3% headline yield into a meaningfully higher after-tax income number compared to ordinary income-producing assets. SCHD is your compounding income engine. It pays you quarterly, it grows that payment every year, and it does both simultaneously while its underlying share price appreciates. When the market dynamic breaks, and it will break, your income production must not be interrupted. Pillar 3 ensures it never is. Our third pillar is the Morgan Equity Premium Income ETF ticker, JEPI. JEPI takes a nuanced approach to covered calls that delivers high income while reducing downside risk. Let us break down exactly how this mechanism works, because most retail investors fundamentally misunderstand what they are buying when they own JEPI. JEPI holds a defensive baseline portfolio of approximately 100 low volatility S&P 500 stocks, companies chosen specifically for their stability characteristics rather than their dividend yield or growth potential. On top of that equity foundation, JEPI sells 1 month out of the money call options on the S&P 500 index. The premium collected from selling those options is what funds the monthly income distribution. This is not magic. It is structured derivative income engineering, the same mechanism institutional desks have used for decades to generate cash flow from equity portfolios. JEPI's 30-day SEC yield is 8.45% as of March 31, 2026. That income is distributed directly into your account on a strict monthly schedule, not quarterly, not annually, but monthly. The fund's annual yield has hovered between 8 and 12% since its inception, partly thanks to recent episodes of heightened volatility and high interest rates that pushed premiums up. Let us look at real income numbers. At current rates, $10,000 in JEPI generates roughly $68.58 per month, $823 annually. Scale that up, $50,000 in JEPI delivers $4,115 per year in monthly income. $100,000, $8,230 annually deposited into your account every single month in equal installments. For retirees, for anyone managing living expenses from their portfolio. For anyone who needs predictable cash flow on a schedule, JEPI is structurally engineered specifically for that requirement. Now the critical data point that sophisticated investors track, the drawdown defense profile. JEPI was one of the unquestioned winners of the 2022 bear market. While the Vanguard S&P 500 ETF was losing more than 18% that year, JEPI fell only 3%. 3% loss versus 18% loss. During the same correction, in the same equity market. That is the covered call overlay functioning as a structural shock absorber, exactly as designed. In April 2025, when the VIX spiked above 52, JEPI's options premium income actually increased because elevated volatility inflates option prices. The market panic that destroys standard equity portfolios mechanically increases JEPI's income engine. That is an inverse relationship between market fear and JEPI's cash generation that no standard dividend ETF replicates. The trade-off is fully transparent and worth understanding clearly. JEPI returned 10.5% over the past year while the S&P 500 gained 20.1%, with its option structure capping upside to fund the 8% monthly yield. In strong bull markets, JEPI lags. That is the structural cost of the income and protection it delivers. In flat markets, sideways markets, and declining markets, JEPI outperforms dramatically. Hold JEPI inside an IRA or 401k so the ordinary income drag disappears. Use SCHD for the compounding engine. Use JEPI for the cash flow engine. Together they create a complete income architecture that no single fund can replicate alone. Now let us stop discussing theory and start showing actual money outcomes. $100,000 for different allocation scenarios, all based on live 2026 data. Scenario 1, aggressive growth focus, 80% VTI, 20% SCHD, 0 JEPI. This is the long horizon wealth building structure for investors under 40 who need no current income. T at 80,000 delivers approximately $872 in annual dividend income at 1.09% yield. SCHD at 20,000 delivers $660 at 3.3%. Total year 1 income, $1,532. At 20 years with dividends reinvested, $100,000 grows to approximately $620,000. Scenario 2, balanced income and growth, 60% VTI, 20% SCHD, 20% JEPI. This is the institutional standard model. T at $60,000, $654 annually. SCHD at $20,000, $660. JEPI at $20,000, $1,646 annually paid monthly. Total year 1 income, $2,960. In a strong bull run, VTI captures 60% of full upside momentum. In a 15% market correction, JEPI and SCHD absorb the impact. Scenario 3, income maximized for retirees, 30% VTI, 30% SCHD, 40% JEPI. Total annual income, $4,609, approximately $384 deposited every single month from a $100,000 base. Scenario 4, maximum defense, 40% VTI, 40% SCHD, 20% JEPI. Total, $3,402 annually with significant dividend growth. Engine running on the SCHD sleeve. This portfolio historically survives every market correction better than pure equity allocation while continuing to compound income at double-digit rates. The combination delivers what no individual fund can provide alone: growth, income, defense, running simultaneously, permanently. Most investors skip this section. It is the most mathematically important thing in the entire video. Active mutual funds in the United States charge an average expense ratio of approximately 1% per year. Hedge funds charge 2% plus 20% of profits. Even many passive ETFs charge 0.5 to 0.7% annually. Our three-pillar portfolio: VTI at 0.03%, SCHD at 0.06%, JEPI at 0.35%. Blended across a 60-20-20 allocation, weighted average expense ratio of approximately 0.11%. That is $11 per year on every $100,000 invested, versus $1,000 per year at the industry average active fund rate, versus $1,500 to $2,000 per year with a traditional advisor's 1.5% annual management fee. Over a 30-year compounding horizon at a 9% annual return. That fee difference on a $100,000 starting investment compounds into over $240,000 of additional wealth. $240,000 in your pocket versus your fund manager's pocket, from the same underlying assets, same market returns, just different cost structures. This is the invisible tax on wealth that the financial industry never discusses loudly. Our three-pillar structure eliminates it permanently. Structuring a bulletproof portfolio does not require complexity. It requires discipline and the right three instruments. VTI for total market accumulation, SCHD for compound dividend growth, JEPI for immediate monthly volatility shielding. That is the complete institutional portfolio architecture. Drop a comment right now. Are you running pure growth, dividend income, or have you already built the three-pillar system? I read every single comment. Subscribe to ETF Holdings USA every week. This channel delivers the institutional wealth engineering frameworks that private advisory firms charge thousands of dollars to access, completely free. Stay disciplined, stay invested. See you in the next analysis.